Hey, it's Tom here and welcome back to the channel. So if you've been following me for any length of time now, you'll probably know that I'm generally not one to spend a whole lot of time on sort of macroeconomic factors or whole stock market valuation type metrics when it comes to my investing. I don't particularly care if the stock market is trading at a PE of 10 or a PE of 100 on sort of an overall basis. I don't really care for a bunch of speculation about what interest rates are likely to do out into the future. Where I really like to spend my time is trying to get into the nitty-gritty and understand all the nuances and competitive advantages and valuations of individual companies. And if I like an individual company's business and I like the valuation that it currently trades at, I will make that investment kind of regardless of what the overall stock market valuations sort of look like. But from time to time, there is research that comes out in these kind of areas, in the sort of more whole stock market valuation type areas, that does really catch my eye. And I want to basically share some really interesting findings that I've just come across recently in this video. So this is actually a bit of an update video to one that I made last year. The video was titled something along the lines of, "Is this .com bubble 2.0?" And basically in that video, I talked through some research that came out of a value investing company, a quantitative value investing firm over in the US called AQR, which is a company run by billionaire and very successful investor Cliff Asness. And in that video, I talked through some research that AQR had done on this concept of the value spread, basically comparing the cheapest stocks in the market on some sort of quantitative metric, whether that is price to book or price to earnings or whatever it might be, versus the most expensive stocks in the market on those same metrics. And what AQR found is that at the time when I filmed that video, the spread was basically as wide as it had ever been. And in the sort of following months, we actually did see a bit of a sort of recovery of quote unquote value stocks, of the very cheapest and oftentimes some kind of junkier stocks in the market. And AQR actually just in the last couple of weeks have come out with a bit of an update to their thoughts on this whole thing and where the value spread kind of sits today. And they also did some work to understand whether that spread is actually justified, because it's one thing to have a big gap between the cheapest and the most expensive stocks in the market, but whether it's justified or whether this is potentially an investment opportunity is really the core question that you need to answer. So I will link this updated research from AQR down in the description below. AQR also released a short video kind of covering the findings as well. So definitely check that out if you're interested in getting into the nitty-gritty of all the different assumptions and kind of thoughts from AQR and getting those thoughts firsthand. Definitely head down there and check that out. So I will put a chart up on the screen here. This is the chart that AQR have just released on the value spread as they sort of see it today. So on this chart, basically the higher that it goes up on the sort of y-axis, the wider the spread in cheap versus expensive. And in this particular chart, there were basically four metrics that were sort of put together in order to calculate this value spread. So those four metrics were the price to book, price to earnings, forward price to earnings, and enterprise value to sales. And there's basically two ways that you can kind of look at this. The higher that chart goes up the y-axis, the more you could say, okay, maybe the cheap stocks are really cheap, or you could say maybe the expensive stocks are really expensive, or perhaps it's a kind of combination of the two. It's not necessarily saying that the lowest multiple stocks in the market are cheap on an absolute basis. This is really kind of a relative valuation comparison. So it's basically comparing current valuations of really expensive stuff to current valuations of really cheap stuff. Both sectors may be cheap and both types may be expensive in absolute terms, but still this kind of relative comparison I find really, really interesting. And some of the numbers that are showing up are really striking. So we've got a US large cap stocks in the 94th percentile of cheapness in terms of value being cheaper than the most expensive stuff by historical standards. We've got emerging large cap in the 99th percentile, and we've got international large cap in the 94th percentile. Now, the second chart that AQR shared is this one, and this basically looked at some of the underlying growth rates of these different baskets of stocks. They looked at a previous period of time from 1990 to 2017, and they looked at how fast did the actual underlying businesses grow in the cheap basket and the really expensive basket, and what was the difference between those two baskets. And what you will find, I guess, kind of what you'd expect to see is kind of what shows up here, is that the quote-unquote expensive stocks are growing faster than the quote-unquote cheaper stocks. So, typically companies that have higher underlying growth rates in their businesses will get higher multiples, and this is kind of showing up in these different baskets and on this bar graph that you're seeing here. So, as it stood back in that first time period, so from 1990 to 2017, the cheap stocks had underlying business growth of about 9% per year. Expensive had about 13% growth per year. So the differential between those baskets was about 4%. So in other words, if you chose to buy the really expensive basket, you were getting underlying business growth of about 4% greater than if you chose to buy just the cheapest stocks in the market. And obviously if you bought the cheapest ones, then you're getting slightly slower growth. The interesting thing is if you look at things like Toby Carlisle's Acquirers Multiple study, that will show you that actually, even though you're getting lower underlying business growth by buying those cheaper baskets, oftentimes you can get substantially greater returns as an investor, because the price that you pay to get into these businesses is a very, very important factor in terms of the return profile that you will get out of those investments. AQR then goes on to basically show what that growth rate profile looks like today. Is the quote-unquote cheap basket growing just a whole lot slower, or are the companies even shrinking? And we've got these really fast growing expensive stocks that are growing really, really fast, and maybe this gap in growth rate for the underlying businesses is just super wide, and maybe these multiples are justified and the spread is justified, and there's a good reason behind why the expensive stocks are so expensive relative to the cheaper basket. And what AQR found is actually the opposite of that. They found that the cheap basket is forecast to grow about 11% per year over the next 5 years, the expensive basket at about 14% per year, and the differential is only about 3% per year. So not only is this value spread basically as wide as it has ever been, the fundamentals of the underlying businesses actually suggest that perhaps this value spread should be tighter than it historically has been. There's not as big a differential in the underlying growth rates that you're getting from the really expensive stuff versus the cheaper stuff. And the final sort of conclusion from AQR in the study was basically that mathematically the cheaper basket basically has to have a better forward-looking return profile relative to the expensive stuff. The fundamentals just do not justify this sort of spread in valuation. So this was a really interesting study for me to come across, and I think there's a couple of kind of questions that I have around how investors should interpret this information moving forward, because I am not a quantitative value investor. I'm not someone that's going to, generally speaking, go out and just buy a basket of quote cheap stocks. And if you've been a Warren Buffett follower or a Charlie Munger follower for any period of time, you probably really won't be thinking about the world in terms of cheap stocks and expensive stocks. You really think about the present value of future cash flows, and paying a high multiple for a business can be justified if the underlying growth is there, which is actually something obviously AQR have looked at in the study, but you're generally not going out and just on a quantitative basis buying the lowest multiple stocks around. And the other thing that jumped into my head is, how do interest rates fit into this whole thing? Because we know that if you're a discounted cash flow style investor, which a lot of professional investors are, as they try and project out future cash flows and they discount those back at some sort of interest rate. If interest rates are lower, it means that those sort of back-end cash flows and those far out kind of cash flows can be more valuable than they would be if interest rates were higher, which leads people to go on to then justify paying much higher multiples for businesses as well. So from a practical perspective, how do I see myself kind of interpreting some of the results from the study and using that in my own investing moving forward. I think I will basically continue to be largely agnostic to things like multiples of current earnings and that sort of thing. I really am a sort of present value of future cash flow type investor. So if a business is growing faster, I will be willing to pay a higher multiple. Of course, if you pay a higher multiple and that growth doesn't show up, you can get in trouble. So margin of safety is always important. But I'm always pretty much agnostic to growth rates. I will invest in a business trading at 30 times earnings, or I will invest in a business trading at 3 times earnings. If I can understand what I think the future cash flows look like for each of those types of businesses, and if I think both of them are equally sort of undervalued. But what I will say, anecdotally at least, is that many of the investment kind of write-ups and things that I've been coming across recently, and particularly some of the more compelling ones that kind of pique my interest, many of them have been focused down in sort of the very low multiple kind of area of the stock market. Things with low PEs or low price to books or low EV to sales, I think was the other one that I mentioned AQR looked at. Now, I think that probably is a result of some of just the widespread in valuation that we're seeing in the markets. There's a whole lot of stuff I can assure you that I just passed on in basically 2 seconds because they're trading at 20 or 30 times sales, let alone 20 or 30 times earnings. And oftentimes these are businesses that aren't even earning any money yet. So I can see that there are things that are obviously kind of easy passes for me in terms of investments, and it really has led me to perhaps focus a little bit more on the cheaper stuff. I still have higher growth businesses in my portfolio, I have lower growth businesses in my portfolio, but I think if you were looking to focus on a particular area of the market as a new sort of hunting ground, then perhaps maybe some of these lower multiple areas are a good place to look around. I know we've seen investors like Monash Pabrai, for example, just this year have quite a big shift in investment strategy and move towards more of the faster growth type businesses. And, as much as I admire that, and I've seen many of the top investors throughout history kind of go down that track as they've scaled up, obviously Warren Buffett moving from cigar butts to great businesses at reasonable prices is probably the best example of that. As much as I appreciate that strategy change and I can see many of the benefits behind it, I still think that hunting around for these 50-cent dollar type investment opportunities is a pretty good place to go, particularly if you're not managing hundreds of millions or billions of dollars, where you basically can't invest in a lot of the kind of smaller companies that come across your radar. So that's it for me for this one. Like I mentioned, I'm not typically one to kind of focus on this more macro level stuff, but this one kind of jumped off the screen at me when I came across it just last night. So I hope you found that interesting, and if you've got thoughts on it, definitely drop them down in the comments below. I'd certainly be interested to kind of get your general feel for whether you're finding a lot of opportunities in the junkier, lower multiple stuff, or whether you may be finding more in the higher growth stuff. Be interested to get a feel for how people are currently experiencing stock market valuations when we are finding interesting investment opportunities. But like I say, that's it from me for this one, and I will see you in the next video. Cheers.